Hi there. So again, hedging with Jorge, hedging with me. Remember, the last time we have seen a clear example when you buy aluminium and you don't find your customer until you find it, but you had already paid 2,500, and your customer tells you that he would take the aluminum, but you would just fix the price, let's say in July. The price would be fixed, and let's say the third Wednesday of July. So on the one hand, you bought aluminum at 2,500. On the other hand, you sell to your customer aluminum with the price to be fixed on the third Wednesday of July. So where's the business? The business is because when you bought the aluminum, you paid a certain premium, but now when you sell it, you're going to collect a higher premium. So your real business is the differential because between the premium paid and the premium to be received, the premium on the physical, okay? But not on the basis. If you don't hedge, if you don't protect the price, you are facing the prices to go down and you may lose the complete differential on the premium. So you need to hedge. How you need to hedge? You know that you need to establish a short position in the futures market. And let's say there is a contango. We were working, I think, with $4-6 contango. Let's use 6. So you sold in the future market as a hedge. As soon as you bought the commodity, you hedged at 2,506 for July. Okay, so you're completely protected because, and again, we said, it's like you sell twice, one to your customer and the second time to the LME, but only you're gonna unwind your sale at the LME, buying it back at the same price and at the same moment you're fixing with your customer. And we studied the case that the prices were going down. And today I'm gonna open the other scenario and open a new tool. So let me go into the example. So we said we are gonna work on an example when the prices go higher, go up. So the case is that the price goes up until 2,600. Remember, you had sold in the future market at 2,506. So you are gonna buy back your future position at 2,600, and you are gonna also use 2,600 as your price of sale. So in the sales, in your invoice, the price is going to be 2,600 plus the premium. But let's forget about the premium analysis. On the basis you bought at 2,500, and on your invoice to your customer, you're going to invoice him at 2,600. So it looks like you're making $100 on top of the money you make on the premium differential, but not, because at the LME you have this sale at 2,506 and your purchase at 2,600. So you make $94 loss at the LME. The loss comes to your global position, deducting the profit of 100, so you just made an additional $6 plus the premium differential. So in other words, this means that if you go short as a hedge at the LME and the prices go up, you make more money on the physical, which is compensated by a loss at the LME. So that means that you have lost the opportunity of the upside of the market. In this case, the upside of the market was almost $100. Net, it was 94, because remember, you sold with a contango. And at the moment, having followed me, having seen the videos, you understand exactly what I'm saying. I strongly recommend you that while I'm speaking, you draw the numbers. You listen to this video again, draw the numbers, but we don't finish here. If we finish here, we understand once again the principle of hedging with futures, that your completely economics are locked in on the price of your hedge, which in our example is 2,506. Is there another alternative to hedge? Absolutely yes. How can I benefit of the profit being hedged when the market goes up? Is throughout options, which means that instead of selling futures, what you do is you buy a protection against the prices to fall. This is called put. Yeah? So in our example, you bought a put. You have to buy a put to protect against the fall. There was not fall, there was a price increase, and perhaps your final position is going to be much higher. We'll continue next week.